Hello, this presentation analyzes the impact of COVID-19 on Canada economy from 2019 to 2024, with a particular focus on market volatility and the central bank policy response. First, the pandemic caused a sharp economic contraction, with Canada GDP falling by 6.06% in 2020 due to lockdowns. Although physical stimulus supported a 5.33% GDP rebound, the recovery was accompanied by lasting structural shifts, particularly in consumer spending behavior, which have slowed Canada's economic growth relative to other OECD countries. Initially, inflation remained subdued due to weak demand. However, to stabilize the economy, the Bank of Canada expanded the money supply by around 30%. While this prevented deeper economic damage, it later contributed to inflation peaking at 8.1% in 2022, forcing aggressive monetary tightening. In summary, COVID-19 had a significant impact on Canada's economy, making central bank response crucial in managing both short-term shocks and long-term economic stability.
Hi, my name is Jin. First, in response to the COVID-19 shock, the BOC implemented conventional monetary policy through aggressive interest rate cuts in March 2020, and the policy rate was reduced in three unscheduled moves from 1.75% to 0.25%, reaching the ELB. And these cuts lower borrowing costs, supported credit availability, stabilized financial conditions, and also helped anchor expectations that interest rates would remain low. So the lower policy rate also contributed to a weaker Canadian dollar, supporting export demand. However, once the policy rate reached the ELB, further stimulus relied more heavily on open market operations. So the bank significantly expanded repo operations and also introduced several market functioning programs, including purchases of bankers' acceptances, commercial paper, and also government securities. So this measure injected large amounts of liquidity into the financial system, restored short-term funding markets, and also lead to a sharp expansion of the bank's balance sheet in 2020. And the large-scale liquidity injections fundamentally changed the bank's operating environment, causing a shift from a corridor system to a floor system. So under normal conditions, the BOC operates a corridor framework where the overnight rate fluctuates between the bank rates as a ceiling and also the deposit rate as a floor, and with the target set at the midpoint. So during the pandemic, however, the substantial expansion of repo operations and also asset purchases created abundant settlement balances. So as a result, the overnight rate was consistently pushed towards the deposit rate. And in this environment, the deposit rate became the effective anchor for short-term interest rates, allowing the BOC to maintain effective monetary control despite excess liquidity in the financial system. When the policy rate reached the ELB and the economy remained weak, conventional monetary policy became insufficient to support recovery. So as a result, the BOC shifted to unconventional monetary policy tools, mainly quantitative easing, which is QE, and also extraordinary forward guidance. So first, under QE, the BOC expanded the Government of Canada bond purchase program. So once financial markets had stabilized, the program shifted from supporting market functioning to providing macroeconomic stimulus. So the BOC purchased at least CAD 5 billion of government bonds weekly, financed by issuing settlement balances. And these purchases increased bond price, lower long-term yields, injected liquidity into the financial system, and also encouraged investors to rebalance towards riskier assets. So consequently, the BOC's balance sheet expanded significantly between 2020 and 2021. The balance sheet rose from CAD 119 billion to CAD 499 billion, largely due to the CAD 406 billion in GOC securities holding. The BOC implemented extraordinary forward guidance for the second time since the global financial crisis, and the bank committed to keeping the policy rate at 0.25% until the economy had fully recovered and inflation returned to its 2% target. So this guidance was aimed at shaping expectations about the future path of interest rate, thereby reinforcing monetary accommodation and also supporting the economic activity. So although the immediate impact on market rates was limited, since the policy rate was already at the ELB and also QE was in place, so forward guidance helped reduce uncertainty and also stabilize long-term interest rate expectations.
Hi, my name is Iris, and I will now present part 4, the impacts on the major bank balance sheets. In Canada, we focus on the Royal Bank of Canada, RBC, as it is the largest and most influential bank, making it a representative case for analyzing how policy actions and the COVID-19 shocks were transmitted through bank balance sheets. With its extensive customer base and the largest total assets among the major Canadian banks, as shown in the bar charts, RBC is well suited for balance sheet analysis during the pandemic. The interest rate cuts significantly affected the asset sides of RBC balance sheets. Rising deposits were allocated to highly liquid assets, particularly Government of Canada securities and central bank reserves. This reflected both higher liquidity preference during market volatility and the effects of the Bank of Canada QE program. Under QE, government bond purchases increased settlement balances, recorded as cash and due from banks in RBC balance sheets, which rose sharply from 26.3 billion Canadian dollars in 2019 to 118.9 billion Canadian dollars in 2020. At the same time, RBC loan portfolio showed clear signs of pandemic-related stress. Corporate loans increased from 291.6 billion Canadian dollars to 294.3 billion Canadian dollars in 2020, as firms drew down the credit lines for liquidity, contributing to a rise in total loans from 618.9 billion Canadian dollars to 661 billion Canadian dollars in 2020. This expansion was accompanied by higher loan loss provisions, reflecting increased credit risks and a deteriorating macroeconomic outlook. The Bank of Canada policy rate cuts to near zero levels in March 2020 injected significant liquidity into the banking system. Households and firms shift funds into bank deposits for safety, and the RBC's total deposits rose from 886 billion Canadian dollars in 2019 to 1,011.9 billion Canadian dollars in 2020. In addition, the Bank of Canada expanded its term repo operations to provide short-term liquidity to banks. RBC made use of these facilities, leading to a temporary increase in cash balances. On the liability sides, obligations related to repurchase agreements rose from 226.6 billion Canadian dollars to 274.2 billion Canadian dollars in 2020, indicating greater reliance on secure short-term funding. These term repos complemented QE by providing emergency liquidity during periods of market stress. So overall, RBC's balance sheets during the pandemic highlights the combined effects of economic stress and the Bank of Canada policy actions.
Following that discussion, I will extend the analysis to the post-pandemic period, from 2022 to 2024, before concluding with a comparisons between the pandemic and post-pandemic phases. By 2022, inflation had risen well above the Bank of Canada 2% target. In response, the bank ended its emergency liquidity facilities and assets purchase program, shift away from extraordinary forward guidance toward a data-driven approach, and made the flow system permanent. The policy rate was also increased rapidly from 0.25% to 5% by mid-2023, and passive quantitative tightening was introduced by allowing Government of Canada bond to mature without reinvestment. As a result, the Bank of Canada balance sheet declined from 410 billion Canadian dollar to 277 billion, mainly due to a 121 billion reduction in bond holdings. These policy changes had clear implications for Royal Bank of Canada balance sheet. On the asset side, cash and due from bank fell significantly from 113 billion in 2021 to 56 billion in 2024. This reflected both lower system-wide liquidity under QT and the reallocation of assets pandemic-era cash into higher-yield liquid assets. Loan growth also slowed sharply, especially in mortgage, as higher interest rates reduced borrowing demand. Rising credit risk led RBC to increase its loan loss provision. On the liability side, deposits expanded strongly, rising from 1.1 trillion in 2021 to 1.41 trillion in 2024, as higher interest rate encourages shift toward term deposit and government investment certificate. Meanwhile, tighter liquidity conditions led RBC to rely more on market-based funding to meet client demand, with obligations related to repurchase agreement increasing by 65 billion in 2023. To compare the two periods, we see a clear shift from crisis management to economic normalization. During the pandemic, the primary policy objective was to stimulate short-term economic activity and support recovery. From 2022 onwards, however, the focus shifted decisively toward curbing inflation and restoring price stability. Besides, the bank moved away from unconventional crisis measures such as QE and extraordinary forward guidance, and returned to more conventional monetary policy, relying mainly on policy rate increase and data-driven guidance. In terms of liquidity, QE led to a large expansion of the balance sheet and money supply, whereas QT withdrew liquidity from the financial system, heightening overall financial condition. In terms of outcome, while monetary easing helped prevent a severe economic downturn, it contributed to excess liquidity and inflation. By contrast, the tightening phase raised borrowing costs and slowed credit growth, but was necessary to restore long-term economic equilibrium. Turning to major banks' balance sheet, asset side trends reversed across the two periods. Cash and due from banks surged during QE as the central bank injected massive liquidity through bond purchase and lending facilities, but declined under QT as reserves were withdrawn and funds were reallocated into higher-yielding securities. Loan growth was initially supported by low interest rate but slowed down as policy rate rose and credit risk increased. On the liability side, deposit and short-term borrowing increased in both periods, but for different reasons. During QE, deposit growth was mainly driven by precautionary saving, while it later shifted into higher yield deposit. Similarly, short-term borrowing initially reflected abundant low-cost funding, while later growth was driven by greater reliance on market-based funding.
Now let's move to the hypothetical implementation of the central bank digital currency, or CBDC. During the pandemic, the rapid shift toward digital payment and cryptocurrency intensified discussion around CBDC. A CBDC is the digital form of central bank money, distinct from deposit held at commercial banks. This section briefly analyzes how a CBDC could have influenced Canada's response to COVID-19. From a monetary policy perspective, a CBDC could have strengthened policy transmission. During COVID-19, when the Bank of Canada cut interest rate to 0.25%, it relied on commercial banks to pass leases cut on, creating tight legs. An interest-bearing CBDC would have allowed the central bank to influence household saving and spending more directly, accelerating policy effectiveness. It will also provide a safe domestic alternative to cryptocurrencies, supporting Canada's monetary sovereignty. However, this efficiency comes with risks, particularly financial disintermediation. In a crisis, households might shift deposits from commercial bank to risk-free CBDC accounts, triggering a fight to safety. This will weaken bank deposit funding, increase their reliance on costly wholesale funding, and potentially lead to higher lending rate and tighter credit, exactly when liquidity is most needed. As a result, safeguards such as CBDC holding limits will be necessary. Overall, a CBDC represents a double-edged sword. On the positive side, it could enhance financial inclusion, enabling faster physical transfer to underbanked households and reducing transaction costs for small business. On the downside, excessive migration to CBDC could reduce bank lending capacity, slowing investment and job creation.
For now, we will focus on the Bank of Canada's current policy stance. The Bank of Canada has no immediate plans to introduce a retail CBDC because Canada's existing payment system is already efficient and inclusive. Nearly 99% of Canadians have access to banking service, and digital payments like debit, credit cards, and e-transfer are widely used. Instead of launching a CBDC, the bank is prioritizing regulatory oversight of payment providers, improving cross-border payment efficiency, and rolling out the real-time rail, which enable instant payments. Since current system already made public needs, the bank view a retail CBDC as unnecessary for now, and only keeps it as a future contingency option. Second, there are strong public concerns. Around 79% of Canadians do not trust the bank to issue a secure digital dollar. Main worries include cyber risk, loss of privacy, and government surveillance, especially due to the centralized and traceable nature of a digital currency, which could reduce anonymity in daily transactions. Third, cash is still widely used. About 20% of transactions are in cash, and Canadians hold large amounts of physical currency because it offers privacy and spending control, and no exposure to the digital risk. Overall, the cost and risk of a CBDC currently outweigh the benefits, so Canada does not need a retail CBDC at this stage. To conclude, COVID-19 caused a major shock to Canada's economy. The Bank of Canada responded in two stages. First, with rate cuts and quantitative easing to stabilize the economy, and later with rate hikes and quantitative tightening to control inflation. This policy significantly affected commercial banks like RBC, increasing liquidity during the crisis and forcing adjustment during the recovery. Finally, despite theoretical benefit, a retail CBDC is not necessary in Canada due to strong payment systems and public concern over the privacy and security. That is our key takeaway. Thank you for the listening.